Today, the Bombay Stock Exchange stands as a titan of global finance. Its glass towers represent decades of growth, acting as the primary engine for the Indian capital market. But a century and a half ago, the city's financial landscape was unrecognizable. In the 1860s, trading was an informal, crowded scramble happening under banyan trees on the streets of Bombay. That informal market was suddenly thrust onto the world stage in 1861. The outbreak of the American Civil War instantly severed the United States' supply of raw cotton to the global textile market. This created a crisis for Europe's massive industrial spinning machines. Without their primary supplier, the textile mills of England and the continent were suddenly starved of the material required to sustain their production. As Europe looked for an alternative, the weight of that global demand fell directly on the Bombay Presidency. The city was now the critical supplier for the world's most important industrial commodity. The revaluation of a local crop into white gold pulled in a surge of revenue that felt like a permanent shift in fortune, even if its foundations were thousands of miles away. The scale was staggering. In 4 years, Bombay's cotton exports doubled to over 1 million bales. This chart tracks the resulting bullion influx. Of 85 crore rupees of gold and silver entering India, 52 crore landed directly in Bombay. But the city lacked the formal, regulated investment structures needed to absorb that much liquid cash. Wealth was piling up with nowhere safe to go. A share mania took hold, as citizens used bank loans to buy stock in untested companies, assuming that prices would never stop climbing. Bombay's financial ecosystem had effectively decoupled from the real world, basing its survival on a temporary global anomaly rather than sustainable value. In 1865, the anomaly ended. The American Civil War concluded, and U.S. cotton immediately returned to the global supply chain. Indian cotton could not compete with the quality and pricing of the American variety. Almost overnight, the demand that had built the Bombay boom vanished. This graph shows the price of Indian cotton plummeting. As export volumes collapsed, Bombay was hit by a rapid wave of bankruptcies. July 1, 1865 became a black day. Investors watched 45.8 crore rupees evaporate into unsaleable paper. The bubble had burst, proving that wealth built without a competitive foundation is nothing more than fuel for a fire. Disgraced brokers were chased from their street corners by police, eventually settling in a new permanent location that would become the heart of the Indian market, Dalal Street. The crash forced a professionalization of the trade. In 1875, the need for regulated business practices led directly to the formation of the BSE, creating the formal structure the city lacked during the boom. Looking back, the investors of the 1860s fell into a trap that Indian philosophy has long warned against. In the Mahabharata, the loss of a kingdom began with a single, uncalculated gamble, the decision to put everything on stake during a game of dice. Like that epic failure, the share mania was a total surrender to chance. Investors gambled their futures on a war they couldn't control. This structural model from the Arthashastra identifies the specific tool they ignored: pratyaksha, or direct empirical knowledge. While the 1860s market ran on emotion, pratyaksha demands logic and fact. Applying this required investors to realize the war and its monopoly had a finite end. The 1865 crash remains a case study in the danger of riding a temporary resource wave. Lasting economic growth requires the foresight to measure the horizon and the discipline to build foundations that can survive when the wave finally breaks.